following the raise of a new domestic borrowing of 7.04 trillion naira through Nigeria's debt capital markets in 2023. We'll take a look at Nigeria's debt strategy to reduce its debt service cost. Chuka Nwachukwu, head of ALM and balance sheet management at UBA, joins me now to discuss the first quarter projections and investors' leanings at the fixed income and forex market. Thank you so much for your time, Chuka. Before we get into all of that, let's first get what sentiments have been like this week at the market.
Okay, thank you, Ken, and Happy New Year. Market has started on a very bullish note, especially on the longer end of the curve for the bond market, and then, of course, the longer end of the curve for the T-bills market. So we've seen rates, move from double digit to single digit. We've seen 1 year, for example, move within 3 weeks from 13 levels, 12 levels to about 9 to 8.5 levels. This week, we've seen the first auction. We have auction, which result just came out some few minutes ago. Okay. About 300 billion was offered. The longer end of the curve, we saw about 275 basis point movement in yield from the last auction result. It came out at 15% to 17.75%. So that's obviously took industry watchers by surprise because, with the low yield we've seen over the past few weeks, we didn't expect to see this much high.
Yeah, because I was going to get to that and talking about the T-bills, the yields we're seeing play out, the auctions that we're seeing, and in terms of trends that you're expecting to play out this year, what are some of the ones you're looking like that are looking likely to materialize?
Okay, so if you look at the budget and what the government tends to do, you will see that they are looking to borrow more, and so feelers is that, if they are going to borrow more, then we should expect a favorable yield, see yield around the upper 14, 15 levels. But for the past few weeks, we've seen, decline in yield. This is also obviously has to do with, system liquidity. On Monday, for example, system liquidity was as high as 800 billion, despite the CRR debit and all that. So the system liquidity is what is actually driving the downward movement in yield. This obviously you rather just buy whatever it is at even if it's 5% than lose it to CRR at 0%. So that's where we have the bullish sentiment, and that's why we've seen the downward yield.
But in terms of your liquidity expectations for the year, what can we expect going forward then?
So we have maturity tomorrow, maturity. Of course, but of course it's in and out, so it wouldn't really have much impact in the market. But then, of course, towards the end of the month, we see FAC coming. Last FAC, we saw well over 1 trillion was shared among the three sectors of government. So that is the only major liability we expect to see, other than, of course, the normal inflows. But again, somehow some banks have maturities, and then, of course, inflows that have been in the system. So this will obviously continue to keep the system liquid, of course, with the CRR debit to moderate things as well.
But when you talk about your biggest concerns for the market this year, for example, looking at inflation at the levels that it's in right now, how do you think that's going to impact the market in the longer term at these levels, with inflation at these levels?
Yeah, so inflation at this level obviously is a cause for concern. However, if you watch, part of the strategy the government has put in place is to see how they can moderate the inflation. But inflation has over 27%. I don't think that any investor, will want to be comfortable with that. But again, I think, I believe that with the government policies and what they are looking to do, most investors will be looking at, positive end, towards the probably see inflation moderate towards end of second quarter or maybe first quarter. So presently, it's not looking good, especially for those who are investing in a fixed income security instrument.